All right, let's dive into the latest numbers from KPIT Technologies. We're going to break down their third quarter performance for fiscal year 2026. KPIT is a huge name in automotive software, so what's their story this quarter? We'll look at what's really pushing them forward and, what might be pumping the brakes a bit. Let's get right to it.
So boom, right off the bat, the big headline number. We're looking at a 9.4% jump in revenue compared to the same time last year. That's measured in Indian rupees. And, that's a pretty solid number to kick things off with.
Okay, but what if we zoom in a little closer? Compared to just the last quarter, that growth number is 1.9%. So you can see the pace has kind of cooled off a bit, but hey, growth is still growth, right? It's still pointing up.
Of course, revenue is just one piece of the puzzle. What about actual profit? Well, if we look at their EBITDA, which is really just a fancy way of saying their core operational profit, that grew by 6.8% compared to last year. So not just more sales, but more profitable sales, which is what you really want to see.
So to really wrap our heads around all this, here's how we're going to tackle it. We'll start with a quick glance at the overall performance. Then we'll unpack that revenue growth. After that, we'll take a look at profitability. Then the really interesting part, we'll go inside the growth engine. And finally, we'll check out their financial foundation. Sound good? Let's go.
All right, first up, Q3 performance at a glance. Let's just quickly go over those main numbers again.
Okay, moving on. Let's get into the nitty-gritty of that revenue growth. It's time to put some actual currency figures to those percentages.
So you might be asking, what does that 9.4% growth actually mean in real money? Well, here it is. Revenue from operations hit over 16.1 billion rupees this quarter. Just think about that. That's up from nearly 14.8 billion the same time last year. Now you get a much clearer picture of the scale we're dealing with, right?
Okay, quick sidebar. You're going to see this term constant currency a lot. What is it? Well, for a global company like KPIT that deals in different currencies, exchange rates are always bouncing around. Constant currency is like hitting a pause button on those fluctuations so you can see how the actual business is doing, without all that noise.
And this is exactly why that matters. Look at this. Depending on how you slice it, you get a different number. In rupees, year-over-year growth is that strong 9.4%. But convert it to US dollars, and suddenly it's 3.0%. And if you use that constant currency measure we just talked about, the quarter-over-quarter growth is 1.5%. See? Each number gives you a slightly different angle on the same story.
All right, let's switch gears and talk about profitability. This is where we get into the earnings story.
So let's put some hard numbers on that profit. EBITDA landed at just over 3.33 billion rupees. Now here's where it gets interesting. That's a nice jump from the 3.12 billion they made last year, but it's actually a tiny step down from the 3.35 billion they pulled in just last quarter.
So yeah, it's really a tale of two different time frames, isn't it? If you look year over year, you see a healthy 6.8% increase in profit. That's great. But if you look quarter over quarter, it's pretty much flat, actually down just a smidge. So the big question is, why? What's putting the squeeze on their profits in the short term?
And we don't have to guess. The company tells us straight up they had to absorb some wage hikes this quarter. And that, right there, is the key. It's not that their business weakened. It's that their costs, specifically for their people, went up. That's a super important distinction. Okay, this leads us to what I think is the most fascinating part of all this. Let's go inside the growth engine. Where is all this growth really coming from? Which parts of the business are just absolutely crushing it?
And again, KPIT is crystal clear. They point to three specific areas: off-highway, powertrain, and diagnostics. So think heavy-duty vehicles, the stuff that makes cars go, and the tech that figures out what's wrong with them. That's where the action is this quarter.
And whoa, look at this data. This just lays it all out. If you break it down by the type of vehicle, the story becomes so clear. The passenger cars segment, it's actually down a little bit. But then you look over at commercial vehicles, and it's just on fire. We're talking 10.5% growth since last quarter and a whopping 29.1% since last year. That is the growth engine we were looking for.
So, okay, we found the engine. Now let's wrap up by checking the chassis, the company's overall financial foundation. How healthy are they really?
And from the looks of it, their financial health is rock solid. Cash generation is strong, which is always great to see. They're sitting on a net cash pile of 9 billion rupees. And this last one, days sales outstanding, is at 40 days. That basically means when they send out an invoice, they get paid back in just 40 days. That's incredibly efficient and shows they've got a tight grip on their finances. And last but certainly not least, let's look ahead. What's coming down the pipe? Well, this number says a lot. They closed $202 million in new deals this quarter alone. Now, that's not cash in the bank today, but that's the fuel for the rocket ship. It tells you their pipeline for future work is absolutely packed.
So, all of this leaves us with one big final question, doesn't it? On one hand, you have these massive deal wins in a booming commercial vehicle segment. On the other hand, you have rising costs that are putting a little pressure on profits. So, as we head into Q4, the real cliffhanger is, can that explosive growth from new deals overpower those rising costs and really hit the accelerator? That's what we'll all be watching for.